Hi everyone, I guess you may be seeing a lot of info on the social media on the upcoming project in Lentor. So when I mentioned this to my client, right, their first reaction is, another project in Lentor? Because there are already so many projects there. So if you are also thinking like my client, not to worry, because you are not the only one who is thinking this way. That's also the reason why I'm doing out this video, as I wanted to deep dive into this. Okay, so today we'll be covering 5 key topics. So first, a quick overview of Lentor. And for those who may not be familiar with this area, right, if you are not familiar and you would like to get an overview, you can click on the above link to watch the YouTube that I've done previously on Understand Lentor in 10 minutes. Then we will tackle a biggest concern that everyone is concerning, which is the oversupply issues. And whether Lentor is really oversupply. After that, we'll look at the supply timeline and what it means for entry and exit opportunities. We'll also be discussing my pricing expectation on Lentor Garden residences. And finally, we'll examine Lentor from an investment perspective, including rentability, rental yield, and profitability. Okay, and now let's dive straight into the biggest concern surrounding the Lentor today, oversupply. With so many projects being launched within a short span of time, do you think Lentor is really oversupply? This is the 8 parcels of land that has already been launched and bidded. So Lentor Garden residences will be launching in July 2026, whereas the latest bidded land parcel in March 2026 may be launching in next year, March 2027. And this one may consist of up to 500 units. There are altogether 3,453 units that has been launched, inclusive of Lentor Garden residences from 2022 to 2026. Sounds like a lot, right? So it may sound a lot as the first few launches in Lentor, which are all these, were launching approximately at the same time. And there are still another 3 parcels that are yet to be bidded. So as far as we know, government is planning for about 5,000 new homes in the Lentor Hills estate. And now comes the big question. With 3,453 units launched with just in 4 years' time, right? It certainly looks like Lentor is facing an oversupply situation. And to be fair, that's exactly what many people think when they first look at the numbers. So most buyers focus on the total number of units. Once they see more than 3,000 over units being launched in a relatively small estate, the immediate reaction is, isn't this oversupply? Especially when Lentor is generally viewed as a on-stay location rather than the traditional investment hotspot. However, I think there's one more important factor that many people overlook, which is the timing. We shouldn't be looking at the total number of units alone. More importantly, we need to understand when these units actually enter the resale market and start competing with one another. That's why I put out together a timeline which I will go through in the next few slides. As we go through it, you will see the supply story in Lentor may not be as straightforward as it seems. If you have been watching closely on the property news, in last year, July 2025, government has extended the seller stamp duties from 3 years to 4 years. And this will apply to all private residential property purchased on or after 4th of July 2025. And this means that buyer can only sell the property after 4 years instead of 3 years without incurring the seller stamp duty. That's the timeline that I've mapped up for you guys to show you the launch date, the earliest resale eligibility date based on the SSD period, the target TOP timeline for the projects in Lentor. So out of the 8 projects here, right, 6 of them is having the SSD period of 3 years. Lentor Garden will be the first one that follow the 4 years SSD period in this estate. So from this plan, right, we can clearly see that there are some overlapping timelines, which is in year 2026 and 2027. And this is where a few projects may be hitting the TOP together at the same period. And why am I sharing this with you is because we need to identify which are the years where there is a huge supply wave in the Lentor area so that we can plan the exit strategy accordingly. So the good thing about oversupply is the entry price may be priced very competitively, as developer will be worrying if they launch too high, they can't sell. So that's why it is good to take advantage on this, but at the same time, you must be very clear on the timing to exit. And this is actually the launch timeline of the Lentor projects that have been launched so far. So when we map out this timeline, right, something interesting appears. Not all the supplies hits the market at the same time. Instead, supply come in waves. You can see in year 2023 and 2024, there are multiple projects being launching out together. This is a very important thing that I would like to show you right now, which is the first wave. So ideally, most of the people will not want to sell within the seller stamp duty period, right? Unless they can't hold or due to some unforeseen circumstances. So from here, we can actually see in year 2026 and 2027, this is where the earliest Lentor buyers complete their seller stamp duty holding period. This creates the first meaningful resale wave because these owners will become eligible to sell without incurring SSD. And this is also where the competition starts increasing. And the second resale wave is actually when the project hits the TOP period. And it's likely to happen between 2026 to 2028. During this period, multiple Lentor projects will achieve its TOP, including Lentor Hill Residences, Hilllock Green, Lentor Real, Lentor Mansion, and Lentor Central Residences. When project achieves its TOP, more buyers can physically move in. An investor who bought during the launch may be more willing to sell. Some owners who plan to stay may change plans after seeing the market conditions. And resale listing will also increase. And this could make 2026 to 2028 the most competitive period in the Lentor market, with buyers enjoying more choices and sellers facing greater competition. And now, this brings us to an important question. If everyone agrees that the supply is concentrated between 2026 to 2028, right? Does it make sense for developer to launch Lentor Gardens at this time? Lentor Garden Residences is sold at $920 per square feet per plot ratio. And technically, developer has more flexibility to play with in terms of the pricing strategy. But the question is, do they need to launch at lower price as the upcoming parcel bidded by Guocoland was at $358 per square feet per plot ratio higher than Lentor Garden Residences? I will touch on this when I go through the prediction of the pricing later. And in terms of the launch timing, I believe this project may have an advantage. If Lentor Garden Residences launches in 2026, it is likely to achieve TOP around 2030. And given Singapore's 4-year seller stamp duty holding period, the earliest buyer can sell without incurring SSD will be around 2030. And this means owners will be holding through the period that is expected to be the most competitive, particularly during the second resale supply wave between 2026 and 2028. However, there is a natural absorption window of approximately 2 years between 2028 to 2030. So during this period, much of the existing supply is likely to be gradually absorbed by the homeowners and tenants. And by the time Lentor Garden Residences achieve its TOP in 2030, it could potentially be the newest completed development in the Lentor estate, placing it in a favorable position compared to the earlier projects that would already be several years old. And this is the part that many buyers overlook because entry is important, but exit timing is even more important. Why I say so is because if you exit at the wrong timing, you will be facing challenges to offload your unit. So what is the strategy to adopt? And Lentor Garden Residences is expected to TOP in 2030. By then, it will have avoided the biggest supply wave, which is expected to be in 2026 to 2028. And many earlier projects will have already completed their resale, and the projects remains among the newest development in the area. The potential competitors will likely be the upcoming Guocoland project, as the TOP may be the same or 1 year apart. However, the land was bidded at much higher price as 1278 per square feet per plot ratio. And this will definitely serve as a protection to the Lentor Garden Residences pricing. And now, another big question comes: if Lentor Gardens may potentially enjoy a favorable entry and exit timeline, how much are we actually looking at to pay for this advantage? And that brings us to the pricing. And I would like to share with you how do I arrive at my pricing prediction. Personally, I look at it from 3 different angles. Of course, this is just my personal view. If I were the developer, the first thing I will look at is the unsold supply currently in Lentor area. So how many units are still available in the market? And next, I'll look at the transaction prices of the projects that have already been launched. After all, these are the prices that the buyer have shown they are willing to pay. And finally, I'll look at the future land parcels in Lentor. Have there been any recent land bids and at what price they will be awarded? By putting these 3 pieces together, right, current unsold supply, existing transaction prices, and future land costs, I can then form a view on how the developer may choose to price Lentor Garden residences. And here's the unsold units in Lentor as of June 2026. There are altogether 26 unsold units, which is in Hillock Green and Lentoria as of June 2026. And this tells us one very important thing. The demand has been relatively healthy despite there are concerns about the oversupply. And you can see that the unsold supply is only less than 1% in the entire Lentor estate. If the market has already absorbed most of the existing launches there, the next question is, what benchmark will developer use to price Lentor Garden residences? And next, let's look at the land cost versus the transacted prices for the other Lentor projects. If we compare the land cost against the prices buyers are actually paying, we notice something interesting. For harmonized projects such as Lentor Mansion and Lentor Central Residences, the land cost was around 980 per square feet per plot ratio, while transaction prices have ranged from approximately 1914 to 2586 per square feet. And these are real transactions, which means buyers have already shown that they are willing to accept these price levels. Now let's look at the latest land parcel, which is bidded by the Guoco Land in March 2026. The land was bidded at 1278 per square feet per plot ratio, which is 358 higher than Lentor Garden residences. Naturally, if future land costs are significantly higher, developers will likely need to launch at a higher selling price, possibly within the range of 2,300 to 2,800 per square feet. And if the future project was acquired at a much higher land cost, how should Lentor Garden residences, which was secured at only 920 per square feet per plot ratio, be priced? One possible strategy is for developer to come up with a very attractive launch price. Maybe some units will start from 2,000 per square feet range, while the better facing or premium units could be in the range of 2,500 per square feet. The idea is quite simple, is to get the buyers excited, create a strong sales momentum, and build confidence in the project right from the start. And what's interesting is that the next Lentor site is only expected to launch 8 months later. So because of that, the developer may not be in the rush to sell every single unit during the launch weekend. And if the demand remains healthy, they can always gradually increase the price for the remaining units over the time. And so from the developer's perspective, it could be a case of launching attractively to get the ball rolling, then slowly adjusting the prices upwards as more units are sold. And my personal view is also quite simple. I do expect Lentor Garden residences to launch at an attractive price, but I do not expect it to be priced significantly below the existing Lentor project. Based on the transaction prices we have seen so far, right, if the average price starts moving beyond 2,500 PSF range, I would personally be a little bit more cautious and take a closer look at the numbers before making a decision. And pricing is ultimately determined by the demand. As for the remaining unsold units, right, there's also a possibility of further price adjustment down the road, especially if market demands remain healthy and future launches in Lentor area are introduced at higher price points. So overall, while I expect Lentor Garden residences to launch competitively, I don't expect it to be dramatically cheaper compared to the rest of the Lentor market. And of course, pricing is only one side of the equation. Can this project generate a decent rental demand and eventually make money? We have covered the price prediction. Now, I would like to cover from investment point of view. So for those who are buying for investment, I'm sure they will be worried if it is easy to rent out and if the rental yield will be good enough. Also in terms of the profitability, should they choose to sell one day? So here, I would like to challenge a common belief because many people assume high rental yield automatically means a better investment. But is that always true? What if the project does not give you a high rental yield? Does it mean the profitability will be low? I would say it depends on your investment objective. If you are focusing on rentability, rental yield or profitability. Some buyers will want to have a high rental yield, more cash flow to fully cover the monthly installment. But some would prefer to have a big lump sum of profits when they want to sell after a few years rather than managing the rental issues. And for Lentor, right, my view is actually this. The rentability, right, will be relatively strong because it sits beside the Ang Mo Kio catchment. And rental yield may face the pressure initially because several projects will complete around the same time. In terms of profitability, it may be a different story over the longer term. That's why I think it's important not to judge the area using the rental yield alone. And I'm going to show you an example what I mean by that. In Singapore, different locations tends to attract different types of buyers and tenants. Some areas are more investment driven and some are more on-stay driven. And areas with stronger on-stay profile often behave a little bit differently. And rental yield may not be the highest, but over the long run, capital appreciation can sometimes be stronger because people are buying these homes to live in rather than purely for investment. And let me give you an example of this. And let's compare Jetscape versus One North Eden. Jetscape is actually located at the Marymount area, and One North Eden is actually located in the One North area. Jetscape is basically surrounded by mature estates such as Bishan, Upper Thomson area. And there are plenty of amenities, established neighborhoods, and a number of popular schools nearby. As a result, it tends to attract more families and owner-occupiers. Whereas on the other hand, One North Eden, right, is located right in the heart of One North Business District and surrounded by offices and research hubs and employment centers. Naturally, it attracts a larger pool of tenants working in the same area. If we look at the similar two-bedder units, right, the difference becomes quite clear. You can see from this diagram itself, the rental for Jetscape is actually around 4,300 per month, while One North Eden, right, can achieve around 5,200 per month, which is roughly a $1,000 difference in terms of the monthly rent. So in this example here, right, if we just strictly talk about the rental income, One North Eden definitely performs better. But that's not the whole story. The key questions for today is actually, does higher rental definitely translate to a better overall returns in the long run? And here we would like to compare the profitability for Jetscape and One North Eden. And if we look at the units here, right, which is purchased in year 2021 and sold in 2024 to 2025 respectively, with a similar holding period, right, we can see a noticeable difference. Despite generating a lower rental income, Jetscape actually delivered close to 200k of higher profit compared to One North Eden. And you can see from this example, right, Jetscape actually make a profit of approximately 400,000, whereas for One North Eden is only about 200 over thousand. And the reason why I'm sharing this is because many buyers tend to focus heavily on rental yield. While rental yield is important, it doesn't always tell the full story. A property with higher rental yield does not necessarily generate a higher overall returns. Likewise, a property with lower rental yield doesn't mean the investment is less profitable. And in many on-stay driven locations, rental yield may be lower, but stronger demand from home buyers can support better capital appreciation over the time. And based on the above scenario that we have shared, how do you determine if one-off Eden or Jetscape is a better investment? So I will say if you require a monthly rental to cover your monthly mortgage as much, then yes, one-off Eden is a better investment in this case. However, if you value profitability more when you exit and do not mind to top up some cash for monthly mortgage shortfall, then Jetscape will be a better choice. So sometimes a property may generate a lower rent, but if its value appreciates significantly more, the extra capital gain can easily cover many years worth of rental difference. So think about this way, you may actually earn about 48,000 less rent over the 4 years. But if you make an extra 180,000 when you sell, the capital gain itself, right, can actually make up for the rental difference. And that's why rental yield is only part of the investment equation. In this case, we can see, right, even after deducting the rental shortfall, right, the overall gain for Jetscape is still about 132,000 more than one-off Eden. And that is also the reason why when evaluating a property, it's important to look beyond just rental yield and consider a bigger picture, including the profile of the buyers, the surrounding amenities, schools, and long-term demand drivers in this area itself. So I've come to the end of my video, and just to summarize, after understanding the data, do you think Lentor is really oversupply? Not necessarily, because oversupply is only a problem if it permanently affects the demand, pricing power, and future resale opportunities. But based on what we have seen today, right, the more important question is not whether supply exists, but whether do you know when the supply enters the market and how you position yourself around it. And once again, thanks for watching till the end. If you have any property questions, need a second opinion before making a decision, or would like to explore whether Lentor Garden Residences is suitable for your own situation, feel free to reach out to me. I'm always happy to have a no obligation discussion and share my thoughts. Take care, and I'll see you in the next video.